Hello everyone and thank you for joining today's True Trading webinar. I'm excited to be here with you. My name is Muhammad Azim from Traders United. First, it is disclaimer. True webinar house rules. Please take the time to read important rules for webinar attendees. Let me start by sharing a little information about myself. I am a certified elite wave analyst, having earned my level 1 certification uh, back in the year 2012 with a score of 93%. This certification deepened my understanding of market behavior, especially through the lens of elite wave theory. In addition to my work as an analyst, I am also an author and educator. I wrote Introduction to Elite Wave Theory, a book designed to help traders like you build a strong foundation in understanding the intricate structure of market waves, but my expertise does not stop at elite wave. Over the years, I have expanded my knowledge into broader market analysis, diving deep into market trends, chart patterns, and price action strategies. So, whether you are a beginner or an experienced trader, I aim to provide you with valuable insights that will help you navigate and succeed in the Forex markets. With that, let's dive into today's session. These are the session goals. Let me talk about macroeconomic events and data releases. I am going to cover previous week fundamental analysis. The first one is the Consumer Price Index, also known as CPI. Second one is the GDP, Gross Domestic Product, month over month related to Canada. Okay, let us start with the first one. What is the Consumer Price Index, also known as CPI, year over year? The Consumer Price Index, also known as CPI, year over year measures how much the average prices of goods and services in Australia have risen compared with the same month last year. It is the most widely followed indicator of inflation and directly influences monetary policy decisions by the Reserve Bank of Australia. A higher than expected reading typically strengthens the Australian dollar as it signals rising inflationary pressure and increases the likelihood of tighter Reserve Bank of Australia policy. A lower than expected reading indicates easing inflation, which can weaken AUD/USD because inflation heavily influences interest rate expectations. This indicator often triggers significant volatility. Now, let's take a look at some numbers. The previous CPI number was 3.5%, forecast was 3.6%, and the actual number we got is 3.8%. The pair we are going to focus is the AUD USD currency pair. The market closely monitored Australia's CPI report released at 12:30 a.m. UTC time on November 26th, with inflation trends playing a crucial role in the Reserve Bank of Australia's policy decisions. This data released carried significant weight for AUD USD currency pair traders. The forecast of 3.6% suggested expectations of slightly higher inflation. Traders were watching for signs of persistent price pressures or confirmation that inflation might be moderating. Given the Reserve Bank of Australia's delicate approach, balancing slowing economic growth with elevated price levels, the CPI figure had strong potential to shift market sentiment. Australia has recently seen mixed inflation signals, with housing, energy, and essential goods contributing most to price fluctuations. While inflation has slowed in some areas, several categories continue showing resilience. Now, as far as the CPI number is concerned, we got a 3.8%. That's the actual number we got. The forecast was 3.6%. The CPI year over year is one of Australia's most influential economic indicators. Its direct influence on Reserve Bank of Australia policy makes it a major driver of AUD USD volatility. Traders should consider not only the headline CPI number but also the broader inflation narrative, sector specific pressures, and the market's interpretation of future Reserve Bank of Australia actions. Even small deviations from the forecast can lead to sharp movements, especially during low liquidity hours around the release time. Now, let me show you the chart of AUD USD currency pair. So, AUD USD currency pair is currently trying to rise up over here. If I draw this trend line like this, here it is. So market is probably trying to rise up over here. It is trying to test this bearish trend line. If you take a look at daily chart, this was a breakout over here and then a failure. Market tries to almost test this level but failed. So the way I see the Aussie dollar currency pair actually looks bullish, and we can draw a simple trend line over here. So this is a bullish trend channel, and we'll talk a little bit more about the AUD USD currency pair. So, market was expecting some heightened volatility around 12:30 a.m. UTC time on November 26th. So what happened is that once the news came out, the Australian CPI year over year remains a critical driver of interest rate expectations and a major catalyst for AUD USD movement. With the actual reading coming in higher than the forecast at 3.8%, the market reacted accordingly and AUD USD moved up after the news. So if you take a look at a price chart over here, this is what we got. So on 26th November, market started to move up, and as of today, it is still trying to go higher. The market reacted accordingly, and AUD USD moved up after we have seen 3.8% CPI number. Next one is the GDP, gross domestic product, related to Canada. Now, what is gross domestic product month over month? The gross domestic product month over month measures how much the total value of goods and services produced in Canada has changed compared with the previous month. As one of the most important indicators of economic performance, monthly GDP provides a timely snapshot of short term economic momentum. A stronger than expected GDP reading typically strengthens the Canadian dollar as it signals robust economic activity and may encourage the Bank of Canada to maintain or tighten monetary policy. A weaker than expected reading signals slowing conditions, reducing expectations for rate hikes and often pushing USDCAD higher. Because of its influence on Bank of Canada policy expectations, the monthly GDP releases often generate noticeable volatility in USDCAD currency pair. Now, the previous number was minus 0.1%. The forecast was 0.2%, and we got the same number, 0.2%. The traders closely monitored Canada's monthly GDP release on November 28th at 1:30 p.m. UTC time. After a previous reading of minus 0.1%, the market anticipated a rebound to 0.2%, signaling modest recovery in economic activity. The release was particularly important because Canada has recently experienced lower growth due to high interest rates, weaker consumer spending, and decreased export demand. Forex markets were watching closely to determine whether the economy is stabilizing or facing deeper softness. Given the Bank of Canada's cautious stance, balancing inflation concerns with slower economic momentum, this GDP print had strong potential to impact USD CAD sentiment. Now, if you take a look at a price chart of USD CAD currency pair right over here, we got a slight hit over here in USD CAD currency pair, and it's quite possible that USD CAD is probably going to, try to rise up over here. However, we got this swing low over here, and if we go over to a smaller time frame, let's take a look at a 4-hour chart over here. Market is currently trying to rise up over here, and it's possible that this leg is probably going to stall and we would get one more bearish leg over here in US dollar versus Canadian dollar currency. But this one looks quite possible. We'll talk more about the USD CAD. Coming back to the daily time frame. So on November 28th, we got the drop in market in USD CAD currency pair actually. Leading into the release, Canadian economic data showed mixed signals. The forecast was 0.2%, and the actual number we also got is 0.2%. However, after that, the USD CAD actually dropped. The manufacturing and retail numbers remained weak, services growth appeared uneven, housing activity cooled due to elevated borrowing costs. So we got kind of a mixed financial data signals in Canadian economic data. The 0.2% forecast reflected expectations of a mild short-term economic recovery. Analysts, outlined three different potential scenarios. The first scenario was that we might get a number that is going to be higher than the 0.2%, uh, or the second one was we get the same number. The third was it goes back to the minus 0.01 territory, but the actual number we got is 0.2%. It's not in a negative territory, but still, it's not strongly bullish economic activity. Okay, so we got the drop, and then that is the reason why after this decline, USDCAD rallied back up as well over here. The Canada's GDP month-over-month release is one of the most influential indicators for the Canadian dollar as it directly reflects short-term economic momentum and affects expectations for future Bank of Canada decisions. With the previous reading showing a slight contraction, markets expected a mild rebound, and the actual figure of 0.2% confirmed those expectations. Even so, any deviation from the forecast can trigger sharp short term moves in USD CAD pair, especially during the release window. Beyond the headline figure, traders should monitor factors such as sector level contributions, goods versus services growth, manufacturing and energy output, consumer spending dynamics, and so on. These deeper insights can guide market expectations following the initial volatility and trading outlook. The Canadian GDP month-over-month release is a critical driver of USD CAD sentiment, with the actual figure matching the forecast at 0.2%. The market interpreted the data as a sign of modest economic stabilization. As a result, USD CAD moved down after the news reflecting CAD strength following confirmation of expected economic improvement. Now, let us take a look at previous week global market trends, and I'm going to take a look at euro dollar and US dollar Swiss franc currency pair. So let's start with the euro dollar. Regarding the euro USD currency pair, I was expecting the price action to drop over here, but it kind of retested this level. So if we do get a bullish breakout above 1.1658 area, then I expect further upside in euro dollar. The daily time frame also suggests that market is probably going to show some bullish scenario over here. We extend this trend line. So right over here, this is where we got a bounce in price action of euro USD currency pair. Next one is the US dollar Swiss franc. Swiss franc tried to show us a bullish breakout over here. If we take a look at the daily time frame, the daily time frame showed a bullish rally, but it's still trying to hold itself higher. So it's quite possible that we might get new low in market in coming trading days in US dollar versus Swiss franc currency pair. If you take a look at a smaller time frame, like a 4-hour chart, here's the support area, and market actually manages to breaks below the support level. That is the reason it's probably going to drop. So right over here we got the breakdown in market, then price action rallied back up. It's quite possible it's going to start the decline one more time. Now let me talk about current week's macroeconomic events and data releases. I will be covering the key developments in Forex market with a focus on fundamental analysis. So the current week is the gross domestic product related to Australia. This is the first news item. Second one is the unemployment rate related to Canada. We'll get this news on December 5th. Okay, gross domestic product GDP, and I'm going to discuss the AUD USD currency pair. So what is the gross domestic product? Q over Q stands for quarterly or quarter over quarter. The GDP, also known as the gross domestic product, quarter over quarter measures the change in the total value of all goods and services produced in Australia compared to the previous quarter. As a broad indicator of economic health, quarterly GDP reflects the strength, momentum, and stability of the Australian economy. A stronger than expected GDP reading typically supports the Australian dollar. It signals economic expansion and may influence the Reserve Bank of Australia to adopt a firmer monetary policy. A weaker than expected reading indicates slowing economic activity, reducing expectations of further tightening, and can push AUD USD currency pair lower. If we take a look at the chart of AUD USD currency pair, this is the 4-hour time frame, and the way I see AUD is trying to rise up over here. So it's probably going to move up further because GDP is one of the most important comprehensive measure of economic performance. Forex traders closely monitor this release for its impact on market volatility and interest rate expectations. So on December 3rd at 12:30 a.m. UTC time, the GDP numbers are going to be released. The previous number was 0.6%, forecast is 0.7%, the actual data not yet released. The currency pair we are going to focus is the AUD USD currency pair. The Australian GDP quarterly release is a major highlight for AUD USD traders, providing critical insight into country's overall economic trajectory. With the economy showing mixed signals in recent months, such as rising living costs, softer household spending, and cooling housing activity. This GDP figure carries significant importance. The market is currently expecting a slight improvement from 0.6% to 0.7%, reflecting moderate economic resilience despite global headwinds and tight financial conditions. Traders are watching closely to determine whether Australia is maintaining stable growth or beginning to show signs of deeper slowdown. Given the Reserve Bank of Australia's vigilant stance on inflation and its ongoing effort to balance economic cooling with price stability, the GDP result may heavily influence expectations for future policy moves and AUD USD direction. Now, the recent economic data from Australia paints a mixed picture. For example, retail sales remain under pressure due to declining consumer spending. Business investment trends have been uneven. Housing and construction sectors are experiencing slower growth. Export performance has been supported by commodity demand. With these factors combined, the projected 0.7% growth suggests expectations for steady but not strong expansion. Now, I'm going to discuss three different primary scenarios. Let's say we get a number that is going to be greater than 0.7%. That signals solid economic growth, suggest Australia's economy is more resilient than anticipated, and it could increase the likelihood of a firm or hawkish Reserve Bank of Australia stance, and that's bullish for the Australian dollar. And this means AUD/USD is going to rise up. Well, it's already going up. Uh, by the way, if you take a look at this daily time frame, we got consecutive bullish candlesticks over here. So market is already trying to rise up over here. Now, if the GDP number matches the forecast, we get the 0.7%. That confirms stable, moderate growth. Market action may remain limited, or we might get a sideways price action inside AUD USD currency pair. And the last one is, let's say we get a weaker than expected GDP, meaning the number falls below 0.7%. That indicates rising economic weakness, raises concerns about domestic demand and business activity, and it may reduce expectations of further Reserve Bank of Australia tightening, and that would be bearish for Australian dollar, and AUD USD may drop after that. So these are the different potential scenarios. Australia's quarterly GDP is one of the most influential macroeconomic indicators for the Australian dollar. It provides a clear, comprehensive picture of the country's economic performance and shapes expectations for future RBA actions. With Forex markets expecting a slight improvement to 0.7%, even small deviations from the forecast can trigger sharp movement in AUD USD currency pair, especially during low liquidity early session release times. Forex traders should consider not only the headline GDP figure but also the underlying drivers such as household consumption, business investment, government spending, export and import activity, commodity sector performance. These components help paint a deeper picture of economic momentum and potential currency direction. So expect volatility in the market will likely around at 12:30 a.m. UTC time at the news release time. AUD USD may respond with fast initial spike before settling into a secondary move. Strong deviations from forecast can create one directional movement. So forex traders should prepare for potential liquidity gaps and rapid price swings during the release window. The final key takeaway is the Australian dollar could spike up or spike down after the news release. With the market expecting a modest rise to 0.7%, any surprise, especially a stronger or weaker result, could significantly influence short term sentiment, volatility, and trading opportunities. Next one is the unemployment rate related to Canada, and I'm going to focus on USD CAD currency pair. So, what is the unemployment rate in Canada? The unemployment rate measures the percentage of Canada's labor force that is unemployed and actively seeking work. It is one of the most important indicators of labor market health and provides insight into overall economic conditions. A lower than expected unemployment rate typically strengthens the Canadian dollar. It suggests improving employment conditions, stronger consumer spending potential, and increased economic momentum, factors that may influence the Bank of Canada's policy outlook. A higher than expected unemployment rate signals labor market weakness. It can reduce expectations for Bank of Canada tightening, increase the likelihood of dovish commentary, and often drives USD-CAD currency pair higher. Now, if you take a look at the chart of USD-CAD currency pair, it's trying to bounce back up over here. However, the way I see it could fall back down as well, because this drop is in a 3-week decline and it looks like kind of a deeper pullback over here. So forex traders closely monitor this indicator due to its strong influence on market sentiment, volatility, and short-term price swings in USD CAD. Canada's labor market has been under pressure in recent months with rising unemployment and slowing job creation, reflecting broader economic challenges. High borrowing costs, reduced consumer spending, and softer business activity have contributed to a gradual cooling in employment conditions. With the unemployment rate creeping upward in recent releases, markets are now expecting another slight increase from 6.9% to 7%. This makes the upcoming report a key event for USD-CAD traders, as it could shape near-term expectations around economic strength and the Bank of Canada's policy stance. The December 5th release is particularly important because labor market trends have become a central factor in how the Bank of Canada evaluates the balance between inflation control and economic softness. The recent labor market data in Canada shows slower job creation across multiple industries, hiring declines in construction, retail, and manufacturing, increased part time employment replacing full time roles, wage growth remaining steady but uneven across sectors. The forecasted rise to 7% suggests expectations of continued cooling in the job market. Analysts outline three primary scenarios. The first one is lower than expected unemployment rate, meaning less than 7%, signals improving labor market strength, and that's bullish for the CAD, so USD CAD may move lower. The second one is, let's say we get a 7.0% number, which matches the forecast number. This confirms gradual labor market weakening. The reaction may be moderate with limited volatility, and USD CAD may just go sideways. The last one scenario is higher than expected unemployment rate, meaning we get a number that is greater than 7.0%. It indicates worsening employment conditions, and that's bearish for CAD. USD CAD may push higher. The unemployment rate is one of the most influential labor metrics for the Canadian dollar. It provides a direct look into the strength of the job market and plays a major role in shaping expectations for future Bank of Canada decisions. Given the recent rise in unemployment and the forecast for a further increase, traders should be prepared for potential volatility in USD CAD, especially if the release deviates meaningfully from expectations. Beyond the headline rate, traders should pay attention to net employment change, breakdown of full-time versus part-time jobs, wage growth trends, specific sector hiring and layoff, labor force participation, and so on. The Canadian unemployment rate is a key economic indicator with strong potential to influence USD CAD, with markets expecting a rise to 7.0%. Any deviation, especially a lower than expected reading, could significantly impact short term sentiment and create valuable trading opportunities. Okay, next let us take a look at euro dollar and AUD USD currency pair. The first one is the Euro USD. The way I see Euro USD is probably trying to rise back up over here. I was expecting a drop, but last week Euro USD moved higher. So the way price action is behaving, we might get further upside in Euro USD currency pair. It looks slightly bullish. So this was the pullback, and now Euro is probably, I would say, trying to rise up over here. The next one is the AUD USD currency pair, Australian dollar versus United States dollar. So AUD USD currency pair also looks bullish. We got this nice bullish trend channel, and market is just hovering around uh, this area over here, and it's quite possible that AUD USD is probably going to rise up more over here. Next one is the US dollar versus Canadian dollar currency pair. USDCAD currently it's trying to bounce back up from this bullish trend channel over here. However, this thing could fail as well, and it's quite possible that USDCAD is going to print a top and it's going to drop more. Next one, we have the XAU-USD pair, the spot gold. Spot gold is probably rising up, I would say. So it's possible that the spot gold is probably going to move sideways and then rise up. So the forecast is still bullish overall inside spot gold. If you have any questions or comments, feel free to type inside the chat box and I will be happy to answer your questions. So what we have learned today, we talked about the gross domestic product related to Australia, and we also discussed the unemployment rate related to Canada. And then we also discussed euro dollar, AUD USD currency pair, USD CAD, and spot gold. These are the assets to watch out for profits. What you should do next, stay tuned for the schedule of next week's trading webinar. Subscribe to our social media pages to stay updated with true exciting events, trading content, and market insights. If you want to learn more about trading, visit TradeGeek and access free trading courses for beginner, intermediate, and expert traders. Thank you for hanging around. See you at the next trading webinar on Tuesday, December 9th, 2025 at 12 p.m. UTC time. That's it for the time being from my side. Have a nice day and bye bye.